Thanks very much everyone for coming along today. As Aaron said, it's the first of this retail investment series. Hopefully there'll be others to follow. So we thought we'd kick it off with exchange traded funds. Now firstly, excuse me, but I'm going to start using the acronym ETFs, if that's okay. Just a little bit shorter, a little bit easier on the tongue. And we will probably set to go through about 30 minutes or so and take any questions at the end. Right, firstly, disclaimer. Please read all of this. This is going to be purely class advice. None of this is personalised advice in any way. It's really just a forum to give the audience an idea about the mechanics of exchange traded funds, what's available in the market, how they're traded, and also the global growth of these products offshore. Has everyone read that, by the way? Okay, so these are the topics that we'll look to cover in the 30 minutes or so, and anything that we don't cover, please feel free to ask any questions at the end. So what are ETFs? Well, basically they're made up of a portfolio of securities that are listed on an exchange, so they're exchange traded rather than over the counter. Basically they trade like a normal share, like any stock that you see, Telecom, Fletcher Building for example. An ETF trades exactly the same way, but it is made up of a whole basket of different securities or different shares. It tracks an index. So an index, what I'm referring to there is, for example, in New Zealand we have a benchmark index, the NZX 50. Offshore, things like the FTSE in London or the S&P 500. It can be a stock index, so made up of stocks and securities, or it can be a bond index, a commodity index, or a currency index. They're the most common ETFs offshore. We only currently offer stock ETFs in the New Zealand market. The objective of ETFs is that investors receive a similar or a very similar return to the direct investments of the securities that make up the index. So if the index is tracking at 3,000 for example, and the movements that you see in the index is up 1% on the day, you will tend to see that the ETF will follow that index. It will track it pretty closely. That's the objective of exchange traded funds, that you receive the same performance as the entire index. Most ETFs are passively managed, the vast majority. The funds simply track an index rather than making active management decisions. You don't see ETF managers actually picking individual stocks. Some products can have elements of active management, but just to keep it simple, generally they are very passively managed and they just hug an index. So they're pretty straightforward, pretty simple from that perspective. Funds can be used as building blocks, and this is something that retail investors can do, but also fund managers, advisors and brokers, and they can use an ETF to actually get exposure into particular sectors. For example, property, energy, infrastructure, healthcare, technology, whatever it is. If you want a quick exposure into that sector, you can buy an ETF and there you go. Also size, different markets, different sizes. So you've got the large cap markets, smaller cap markets, so that's capitalisation, or mid caps again. So managers will use it to get exposure to different size stock markets. Geography, it's sometimes very, very difficult. For example, a fund manager in New Zealand might want to get exposure to Southeast Asia or emerging markets, or Vietnam if you want to go down to micro level. Rather than actually trying to analyse countries or stocks within those countries, they can buy offshore ETFs, for example, and actually get that geographical regional exposure very, very simply. It's an effective tool for that. And different asset classes. So again, stocks or equities, fixed income, which tends to be bonds or government treasury bills, for example. Commodities, very well-known ETFs are gold ETFs, for example, are pretty popular. You get the soft commodity ETFs and currency. So they can cover a myriad of different asset types. Right, so the history, we had our 20-year anniversary basically of ETFs last year. First ever ETF was launched by State Street Global Assets, commonly referred to as the SPDR, and that tracks the S&P 500. This is still by far the largest ETF in the world. Fantastic product, 160 billion under management, and trades 117 million units a day. So, not, you know, I'd like to say that our products trade anything close to that, but it's just a pretty amazing product. Interestingly enough, New Zealand was one of the pioneers in ETFs. We launched TENS, Smart TENS, back in 1996. In 1997, New Zealand launched the first ever global ETF. That was AMP with WINS. 2002, the first ever bond ETF was launched offshore, not in New Zealand. And you can see commodities 2 years after that, 1 year after that, the first currency ETF, and 3 years after that, the first actively managed ETF. It's a very innovative industry. There's a lot of change occurring a lot. I won't go into all the different innovations which have recently hit the market, but you may be familiar with things like Smart or Advanced Beta. You may have heard that. It is changing all the time. Our products tend to be very straightforward. And ETFs, as Aaron said, absolutely one of the fastest growing financial products in the world. And this next chart, this is actually just the US market, but this chart is reflective in what's happened globally, really, in Europe, etc. Over the last 20 years, there's been average growth of 20% per annum. There's now over 3,000 ETFs, and that's funds under management of 2.4 trillion. And in the US alone, 1,600 ETFs and 1.8 trillion under management. So it's a pretty incredible story. A lot of the money that is moving into exchange-traded funds or passive funds is coming at the expense of managed funds, which are actively managed. And although this trend is continuing a lot, it's important to note that ETFs still only make up around 12 or 15% of global funds under management. So it's still very much a smaller part than the mutual managed funds. So how do they operate? Again, you know, excuse me if some of the stuff sounds unfamiliar, so I'll try to keep it pretty straightforward. Each morning, the ETF or the fund is valued, so that we look at that as the net asset value, and this is published to the market. The price of this should be in line, or should basically be very, very similar to the same price that you can see on the buying and selling of units on the market. If you go to your broker, for example, it should reflect pretty closely the net asset value or the net tangible asset value that was calculated that morning. Distributions, or in other words, payments, which mainly made up of dividend income. ETFs receive dividends from the individual companies in which they invest. So if you invest, for example, in the S&P 500, 500 companies in the US, each one of those, well, most of those companies will pay a dividend, and those dividends are pooled and they are paid out on a semi-annual basis generally. Sometimes they can be paid out on a quarterly basis, but most ETFs work on a semi-annual basis, quite similar to the way that a normal stock would operate. Unit holders can choose to have these funds as cash, or they may wish to have them automatically reinvested, and a lot of ETF providers globally offer dividend reinvestment plans. Right, what can investors expect from exchange traded funds? The biggest benefit of exchange traded funds by far is diversification. You get exposure to all of the stocks underlying that index, whether it be an index which has 7 stocks or 10 stocks, or one that has 2,000, like the Russell 2000. Basically all of that from one purchase. So it's the similar process you go through to buy one share of telecom is a similar process to buying one unit of an ETF, like TENS for example. This typically reduces risk as the risk is spread or diversified across a whole portfolio of stocks, rather than us as fund managers sitting there going, well, I quite like the look of Mighty River Power, let's invest in that. We just follow the index. There's no active management decisions made. Transparency. The fund holdings are published daily and they're always known to the market. That's quite important because a lot of funds management products that you do buy in the market, the actual transparency or the price of that product is not known necessarily real time. It's not known throughout the day. So it's a great benefit that these are very, very transparent. Unit prices are published in the newspapers, online, and again, similar to any stock that is traded in New Zealand, for example. Lower fees. The management of an ETF in most cases is passive rather than active. The costs are therefore lower because there's less need to have expensive analysts, fund managers and research. Basically, we don't trade very often either. Trading occurs around a rebalancing, quarterly rebalancing for example, and all that means is if we follow the index, if a stock falls out of the index and a new one comes into the index, we must reflect that, so we will trade. But outside of that, there's not a lot of trading that goes on, and that keeps the cost down because the portfolio isn't being turned over. How do you invest in ETFs? Well, they are very much, again, like any stock listed on the exchange. You can buy them via an NZX accredited broker or an authorised financial advisor, or you can buy them on an online trading platform. Cash applications can be made directly to ETF managers. That's not just a New Zealand thing, that's a global process as well, and this is generally just by filling out an application form in the investment statement. So similar to any other fund that you get in the market. These applications are pulled and they're processed at the end of the month, so it's all put together. Again, we don't like trading a lot, we like to keep the fees low, so we will make that trading occur once a month. And a lot of ETF managers will offer a regular savings plan or an RSP. The one that is run at SmartShares, for example, encourages people to save. There is no brokerage fee, it's direct debit, and it's a minimum contribution of $50 per month. So it's pretty straightforward and just clicks away. So what exchange traded funds are there in New Zealand? So there were 6 up until 2012 when AMP closed down their WINS product. There's currently 5 on the NZX at the moment. There's Smart 10s, which is essentially the 10 high cap stocks or the top 10 stocks by capitalisation. Smart Mids, these are the mid cap stocks, so they're the 50 stocks outside of the 10, and we also take out any Australian primary listings out of that category. Smart Fonds, that's more or less the same as the NZX 50 index. It is cap weighted, but that's the main New Zealand index, so if you want to follow that index, that product does that. And we have a couple of Australian products listed on the NZX. They are one that's following the top 20 stocks, which is essentially the S&P 20, which is Aussie, and Mozzie, or Smart Mozzie, which is a mid-cap Aussie fund. So essentially that is the 51 to 100 top Australian stocks by capitalisation. So there's a wide spread there. There's a couple that will be added to the suite of products going forward, but they are the ones currently available on the New Zealand Stock Exchange at present.